Chapter 7, Stock Valuation. This is not where you're going to learn how to become a stock analyst. Well, in some ways, I guess it is. It does give you the foundation as to how is it that we value stock. But our purpose in looking at stock valuation is from a manager's perspective. We really need to maximize shareholder wealth because our shareholders are the owners of the company. And if we don't, we could find ourselves, well, out of a job. So to begin with, what are we talking about? We're talking about common stock. Common stock is the stock in the company that represents ownership. It means if I own a piece of the company, then I own stock in the company. And if I own stock in the company, I own part of the company. If you buy stock on the stock market, then you own a part of that particular company. Stockholders, one of the ways they exert control over the company is by the election of the board of directors. The board of directors then hires management, and managers are the agents of the shareholders. Their goal should be to maximize stock price. For instance, in a September 25th, 2013 issue of Network World, which I'm sure everybody here subscribes to, there was this article which says HP board survives confidence vote but only barely. The shareholders of Hewlett-Packard voted to re-elect its entire board of directors despite opposition from investors who want some members held accountable for recent troubles, including the ill-fated acquisition of Autonomy. The two directors seen as most vulnerable, G. Kennedy Thompson and John Hammergren, narrowly survived with 55.15% and 53.91% approvals, respectively. If they get below 50%, they're off the board. Board of directors actually make a little bit of money. Usually it's tied to the stock price. In other words, they get stock options. And therefore, if they don't do what the shareholders want, they can be bumped off of the board of directors. And if you had enough shares, you could actually elect yourself to the board of directors, and then you would have a vote as to who the CEO is. And if you really had enough votes, you could put yourself and all of your friends on the board of directors and take over the board of directors and boot all of the SOBs out of the management of the company. And that is what has happened in some instances in the U.S. with what's called shareholder activism, as shareholders want their companies that they own not just to return a decent amount of money, but also to be more socially responsible. Sometimes we get shareholder activism. But I digress. In addition to regular old common stock, stocks can come in different classes. One example that I used to use all the time, and their web page doesn't have the full story, is Porsche AG. And by the way, the AG is German for Aktiengesellschaft, which means stock company, something like that. And it means that their stock was publicly traded, although it's not really publicly traded anymore. And by the way, when I say Porsche, I mean Porsche. You know, the company that makes all of the sports cars. I know in Texas, a sports car is called a Ford F-150. For those of you who aren't from Texas, that's a pickup truck. But this is a normal sports car, okay, a Porsche. And Porsche not only made hot rods, but they had some hot rods running the company there for a while. But before I get to the hot rods running the company, let me tell you a little bit about the way it used to be run. This is off the net, and you can still get these pages. At least when I made this, you could still get these pages, which was like a good dozen years after. it was after it was written, because it says copyright. You can't see this, but I can. Copyright 2002. But the company of Porsche was started by a man by the name of Ferdinand Porsche, and it was the same engineer who came up with the Volkswagen, the people's car. And so he started Porsche in 1948, I believe. In fact, if you scroll to the top here, it says founded in 1948 and headquartered in Zuffenhausen, Germany, which is a suburb of Stuttgart. Porsche first issued stock in 1972 and became a public company in 1984. Porsche AG's capital stock of 87.5 million euros is, or at least was, divided into two categories. Half was owned by the Porsche and Piech families, and the other half was essentially sold on the market as preferred shares and a whole bunch of other stuff. The reason they did that, by the way, is because the way they split it up, the Porsche and Piech families would have retained control no matter what. Fast forward to the year 2012-ish, and you will find that Porsche had done some rather creative things in the financial markets and had amassed a great deal of cash and decided to put the legacy of Ferdinand Porsche back together again, meaning Porsche was going to acquire Volkswagen. Unfortunately, the financial speculation that they had been doing all came down in a house of cards in about 2009-ish, my guess is, and they suddenly needed to be rescued themselves. And so somewhere in about 2012, which is what I really meant to say, is in 2012, instead of acquiring Volkswagen, Volkswagen actually acquired them. And so in 2012, the first Porsche Boxster rolls off the production line at Volkswagen Osnabrück. Why? Because, well, the acquisition went in the opposite direction. Despite the fact that the company was run by and owned by the Porsche family, and they were going to insulate themselves from ever being taken over by anyone else, it didn't really work. And that's my one odd little story about two different classes of stocks. Okay, so getting back to the real point of the lecture, however, we come across something called a tracking stock. Tracking stocks are stocks that really wanted to look at just one division of a company. And you're really investing in just one chunk of the company. Not the whole company. You're not going to get a return on any of the company except that one division or that one component of the company. Investors would then look at the value of all of these divisions separately. And by the way, it was kind of helpful if you wanted to compensate division managers for what they were doing. It seemed a little more fair if you were basing their compensation on how well the tracking stock did. It made a whole bunch of sense. The way the market, however, interpreted much of this is they thought, well, you know, if you're selling off stock division by division, what you're telling us, the only way that makes sense to the market is if the company's worth more when we look at it division by division instead of as a whole. And if that's true, why don't we just split up the company? And because of that, over the last decade or so, there haven't been as much with tracking stocks as there used to be. Now, our textbook tells us that there are no voting rights with tracking stocks, but quite often there were voting rights. And the voting rights were proportional to how large the division was over which you were buying the tracking stock. I think what the textbook is talking about, though, is there are tracking stocks that aren't publicly traded as much, and they are used for internal purposes for managers and that sort of thing. Now, the rest of this chapter, we're going to be talking about the valuation models and how do we come up with a price of what this company is worth. The first one that we're going to be talking about is a dividend discount model. It's the Gordon growth model, the constant growth model. And then just to contrast it, we're going to be looking at the non-constant growth model, but I'm not going to look at it with dividends, because in many ways, if you really understand dividends, non-constant growth model doesn't make any sense when you talk about dividends. And so I'm going to talk about it with a free cash flow model. So even though our textbook will look at it, dividend discount model, non-constant growth model, free cash flow model, I'm going to split this up a little bit. So we're looking at the dividend discount model and looking at constant growth model. Then we're going to look at a free cash flow model and then look at non-constant growth models. Then I'm going to, at the very tail end, talk a little bit about these multiples. The PE multiple, the price earnings multiple. These are used quite often to figure out what the stock should be trading at approximately. I need to tell you that there are reasons why these might be good at giving you ballpark numbers. However, these ballpark numbers come with a cargo ship full of assumptions, and therefore they probably shouldn't be used as your final, oh wow, I should buy that stock decision, whether they're price earnings ratios or price cash flow ratios. This all brings us to the Gordon constant growth model. This is the very first one on our list. It's the first one it's sort of like the model upon which all the rest of them are tweaking, okay? So the Gordon constant growth model is the constant growth model that is talked about in all of the textbooks. It was named for Myron Gordon, who was an economist back in the 1950s who proposed a constant growth. And the reason for that is he said, well, really all we're doing is looking at this company paying me a dividend. And since even if I hold this stock for a while and then I sell it, the person who's buying it is looking at the dividend as well. So the value of this stock is really the claim on that infinite flow of dividends. And so to get to that infinite flow of dividends, Myron Gordon made several assumptions. He assumed that the dividend, d sub 0, for now, today's dividend, would grow at a constant rate, which we're going to call G. And then we're going to discount all those cash flows at a discount rate, which we're going to call R sub S. The price of the stock, therefore, could be calculated as just a present value calculation. If all of these things are true, then we should be able to calculate the price of the stock as present value being a sum of infinite dividends. And the way we take any present value is we just sum up all of the cash flows and we discount them at the discount rate. Well, these cash flows grow at the rate of G forever, and then we'll discount them at the rate of R sub S as they go out there forever, from t equals 1 to infinity. The best way of doing this is just algebraically, so bear with me a minute as we get through this. So first off, we're going to look at what that looks like if I expand that. So we're going to have d sub 0 times 1 plus G over 1 plus R sub S. That's what happens the first year. The second year, the dividend grows at 1 plus G squared now. But then again, I'm going to have to discount it at 1 plus R sub S squared. And that's going to continue all the way out to n. Now, mind you, I'm going to eventually let n approach infinity, but bear with me for just a second. And by the way, if that last fraction is still a full-blown number once we get out there toward infinity, we're going to get a present value that's approaching infinity as well. But don't worry, we'll come back and visit about that in just a second. I'm going to multiply both sides of the equation. When I say that, it's both sides of that equal sign by 1 plus g over 1 plus r sub s. They should still be equal, because all I'm doing is I'm doing the same thing on one side of the equal sign as I'm doing on the other side of the equal sign. It will still be true. The real reason I'm doing this, by the way, is because I don't want an infinite number of components on the right side of my equation, and I want to be able to solve for PV. So I multiply both sides by 1 plus g over 1 plus r sub s. You're going, well, you still have an infinite number. I know. But now I'm going to do a trick. I'm going to take equation number 1, and I'm going to subtract equation number 2. And the reason I'm doing that, by the way, is because then on the left-hand side of the equation, I just have PV minus PV times 1 plus g over 1 plus r sub s. On the right-hand side of the equation, I have the very first component, that d sub 0 times 1 plus g over 1 plus r sub s. But then as I go further, I notice that as I take the second number in equation 1 and subtract it from the first fraction on the right hand side of equation 2, they're exactly the same. That's by design, by the way. And when I subtract one from the other, they go away, leaving me with just two components on the right hand side of the equation. In fact, it will just leave me with that. Now, for just a sec, let me take a look at that last component, because I need to talk about that d sub 0 times 1 plus g to the n plus 1. And it doesn't really matter what n's are out there. If I let the n approach infinity, what is that going to be? Well, it kind of depends on what g is and r sub s are. If they are equal, then that would be d sub 0. And I'd have an infinite number of d sub 0s. And if I add up an infinite number of d sub 0s, I get infinity. And so that's not going to be helpful. So if g is greater than r sub s, then I'm adding up an infinite number of things that are growing. They're not only d sub 0, but they're bigger than d sub 0 over time. And therefore, as I get the original summation thing going, I'm going to get infinity again. The only time this works, by the way, is if g is strictly less than r sub s. Then as n approaches infinity, the denominator explodes faster than the numerator, and as n approaches infinity, the entire value approaches 0. Meaning, and here's the real bottom line, meaning two things: that we can solve this, but, number two, g has to be strictly less than r sub s. If it isn't, then the infinite sum goes to infinity. It explodes. So having said that, let's take a look at the left-hand side of the equation. Now that we've got our right-hand side down to just one term, our left-hand side's looking incredibly large. Besides that, I really just want to solve for PV. How do I solve for PV when it's in something so ugly? Well, again, if you've worked algebra problems like I have, since I have children who are in high school still and still working algebra problems, we're going to factor the PV out of everything on the left side. And so the way we do that is just taking, well, PV out of both pieces, and we get PV times 1 minus 1 plus g over 1 plus r. Well, that was easy. Now, before I actually do my little trick and solve for PV, I really need to make that simpler in the parentheses on the left-hand side. And so I note that 1 could be rewritten, or better stated, if I combine those, 1 minus all that junk, why don't we put everything over 1 plus r? 1 is the same thing as 1 plus r over 1 plus r. So if I actually substitute that in for my 1, it's going to expand it a little bit so that we get now 1 plus r over 1 plus r minus 1 plus g over 1 plus r sub s. Okay, so now we have a common denominator. And now we're looking at 1 minus 1. Oh wait, those go away, and we get r sub s minus g over 1 plus r sub s. Now note, so far I haven't done anything on the right hand side, but I'm just about ready to, because I need to multiply both sides by the inverse of that stuff that's by the PV, just to get rid of it and still get an equality. So I'm going to multiply both sides by 1 plus r over r minus g. It's going to get rid of everything on the left-hand side except for PV. So it's going to say PV equals. And then on the right-hand side, note that our 1 plus r in the denominator of the first half cancels, so to speak, with the 1 plus r in the numerator of the second fraction. And it's just going to leave me with d sub 0 times 1 plus g over r sub s minus g. Now also note that since the dividend is growing at a constant rate of g, that if we take the dividend today, that I'm sure of, and multiply it by 1 plus g, then I'll get the expected dividend, that's why it has a hat on it, for time 1. So d sub 1 hat over r sub s minus g. The only reason I point out all of this stuff to you, by the way, is that textbooks usually like to then see how well you can understand the formula, and they'll give you lots of inputs and then say what is the current stock price, and sometimes they'll give you d sub 0, and sometimes they'll give you d sub 1, d hat sub 1, by saying you expect next year the dividend will be such and such. That would be a d1. If they say you just got a dividend, then that would be d sub 0. How do we really use this? Well, to use this for a real company, we would use the most recent annual dividend as d sub 0. We'd estimate g usually by looking at the dividend history of the firm, understanding the firm's dividend policy. And note that I'm not going to get into this in great detail in this chapter because, number one, there isn't any homework for this chapter, and number two, there will be homework that will use all of this information after next chapter. Because in the next chapter isn't going to be the next one in the book. It's going to be chapter 14, which is on dividend policy. So once you understand the firm's dividend policy and what they're trying to convey, then we can say, therefore, if those things are true and the market is actually believing it, then we should be able to get a stock price. So, well, we'll be able to get the G anyway of the stock price. So the dividend, we can look up what they've actually paid. Then the G is the growth rate. And finally, the R sub S is just the required return to the stock by using the capital asset pricing model from chapter 7 in our text. Or we could even use the three-factor model from chapter 7 in our text. Or we could use the arbitrage pricing theory. Any way we slice it, we can get an R sub S. I should mention really quickly, because we've spent so much time developing the capital asset pricing model and some of the thoughts based on it, that we should also spend a little bit of time talking about how people tend to apply this. The risk-free rate, plus the market risk premium. As it turns out, there is a lot less volatility in looking at the total market risk premium. In other words, what does the difference between the expected return of the market and the risk-free rate? If we subtract those two, we get what's called the market risk premium. And over time, it's the market risk premium is far less volatile than those individual components, which can fly all over the place. So rather than try to shoot at something that's really volatile, we're going to shoot at something that doesn't move around very much, which just makes sense. So based on all of that, let me give us an example to look at. The example that I'm going to look at is GameStop Corporation. So just hang on just a sec as we take a look at this through a very quick internet field trip. If we pop to Google and then just type in GameStop, we get quite a few of the inputs. The first input that we will note is we get the quarterly dividend of 33 cents a share. By the way, the dividend yield is just telling me how much of a return this is. It's just taking the 33 cents and dividing it by or actually the 33 is actually a quarterly, so it would be $1.32 divided by this will give me my dividend yield typically. So I'm getting my quarterly dividends of 33 cents. I'm getting my beta of 1.15. Based on those, the only thing that I would need to add is my G. Now, by the way, just so that we get a better feel for what this company is and who they are and what they do, note that they are headquartered in Grapevine, Texas, in the DFW area. And GameStop sells computer games and video games and all kinds of those kinds of games. Some of you are probably wanting to play that more than listen to me. Well, probably everybody is, but that's okay. Even those of you who don't really play video games may be wanting to do that too. But that's essentially what this company does. They sell games. So getting back really quickly to the lecture, D sub 0, most recent dividend, has been 33 cents a share as demonstrated, or $1.32 per year. Since our discount rate is an annual discount rate, we're going to have to use the 1.32 per year. How do we get this annual discount rate? R sub S is equal to the risk-free rate plus the market risk premium times beta. Well, beta we already know was 1.15, but before I get to that, let me talk a little bit about the risk-free rate. Our current risk-free rate is below the inflation rate, which doesn't make any sense based on our earlier discussion of interest rate, and probably has a lot to do with the Fed's quantitative easing policy. So rather than look at the Treasury bill rate, I'm going to look at the Treasury bond rate. It still should have pretty close to zero default risk, but because the Fed isn't playing as heavily in that market, we're actually hopefully able to see some nominal rates in there at 2.45%. At least that's what I'm going to expect. In addition to that, we're going to further assume the long-run market risk premium, the RP sub M, is more stable than its components of the expected return of the market minus the risk-free rate, and tends to fall somewhere between 4 and 8%. And usually I'll use around 5 to 5.5%, and so I'm going to use right in the middle of those at 5.25%. So, having done all of that, then we know that Google estimates their beta to be 1.15. We throw all of that in there, 2.45% plus 5.25% times 1.15 gives me 8.4875%. Now, please, when you enter these into the Gordon growth model, realize that to adjust percents to decimals, we just move the decimal point over 2 places, so this is going to be 0.084875. Having said that, let's now take a quick look at the growth rate. We still have to estimate the growth rate. Now, the growth rate that I'm going to have you do for your company eventually is going to be a function of what they've actually seen in growth in their dividend over the past few years, plus what the dividend policy in the company seems to be, realizing that G must be strictly less than R sub S. So I'm just going to guess 5%. 5% is less than 8 point some blah 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 percent, and so that's going to work. So I'm going to use 5%. And by the way, the 5% is a nominal 5%, which means that I'm expecting the dividend to grow at 5%, despite the fact that I know that inflation is going to eat up at least half of that, or approximately half of my 5%. Therefore, using this to throw it into the actual stock price, the price in real terms, that's why we're doing nominal rates, is d sub 0 times 1 plus g over r sub s minus g. Now the r sub s again is in nominal terms as well. It's not a real rate, it's a nominal rate. And therefore we're just plugging and chugging 1.32 times 1 plus 0.05. We adjusted the 5% from percent to decimal, 0.05. And then we're going to divide that by 0.084875. That's the 8.4875% minus 0.05, the 5%, will give me 39.74. So $39.74. Going back to Google, that's darn close, 39.86. So, and honestly, we could actually hit this right on if we were to tweak just the 5% a hair. And what this may be saying, therefore, is the market is expecting a teeny tiny bit less than 5% growth in dividends between now and infinity and beyond. And that's how we would get, or maybe just a little bit more, excuse me, it should be just a hair more than 5%, or they may have actually used a different market risk premium. We made assumptions on both of those, so when we get that close to the actual price, I can say, well, the market may be right, and I may have just chinned this a little poorly. This actually is a good place to stop because we've actually made it through the very first component of this stock valuation. And at this point, we're going to then transition into a free cash flow model, and then we'll look briefly at those market multiples.